Opendoor released earnings yesterday, and the report contains a lot of information about their strategy to profitability and break even by 2026. Some additional warrants you can get for free if you buy before the 18th of this month, and some financial results. So let's dive into the report and see if I would buy, hold, or sell the stock at these levels. So looking first at the balance sheet, we see, almost a 10+% deterioration in total assets being, the reduction in real estate inventory here. The company mentioned that they were, clearing out their old inventory and they're about to load up here on their new inventory, but, you know, still very much in the turnaround cycle here where, the real estate company, Open Door, is not buying real estate quarter over quarter. And the profit margins and the revenue haven't been, too great either. You can see here revenue in 2024 for Q3 was at 1.4 billion just about, and now they're at about 900 million, a 30% haircut here to revenue. And then if we look down to the net loss, they're at 78 million and they jumped that loss up to 90 million. But I will mention that the company disclosed a one-time make whole adjustment. So you don't see that often. So I was like, what is this? And digging into it, I'm not a big fan of this. Anyway, the company disclosed a 15 million one-time CEO award to Koss. This provision is structured as the make whole payment, and it's designed to compensate Koss here for forfeited equity and incentives from his prior role at Shopify. Where he served as a senior executive before joining Open Door at the end of 2025 here. In my eyes, if I'm really running this company and a turnaround and everything, I mean, this should have been structured as some tier, almost like the warrants. We cross $7, we get paid. We cross $9, he gets paid. I mean, giving this guy $15 million when he hasn't proved to do anything and not tied to any performance metric, I don't like that in my opinion. So I think another key part to look at with Open Door, right? They're a real estate company. How much are they buying? How much are they selling? And this continues to also decline along with the revenues and the profitabilities. Looking in this middle chart here, you can see they sold 3,615 homes at this time last year, but now they've only sold 2,568. And if you look at the homes purchased, I mean, it's been cut into a third here, from 3,500 homes to 1,200 homes. I got to see a lot more before I invest in this company. Now, I wanted to point this out because I saw someone say, "Oh, they're trading at 5 times free cash flow." I'm like, they have free cash flow? I gotta jump in and take a look here. One thing that's important, I know the cash flow statement is probably the most complicated out of the three. Once you learn it's not that bad. So we start at the cash flow from operations, right? Does the company generate money from its day-to-day operations? And the answer is no, right? That's why we're starting off at minus 204 million. Well, now you add back non-cash expenses, right? Because we're getting to the cash flow statement. We don't want non-cash in our cash flow statement. Depreciation's a made-up accounting expense, non-cash. Get rid of it. Ditto for amortization. Stock-based compensation they add back in here because that's discretionary. Then you get down to, why is it positive? Just take a look. What's the biggest positive number? Real estate inventory. There's a thing that gets added into cash flow called changes in net working capital. That is the change in your assets, year over year. And the reason they're showing that positive is because they didn't buy as many houses, which resulted in more cash flow staying with them. So, I mean, is the company free cash flow positive? Yes. Is it free cash flow positive because of a one-time adjustment? Yes. If they bought the normal amount of houses and operated, as a real estate company, would this be negative? Yes. I mean, they're still not producing free cash flow here, guys. And here's the turnaround plan Open Door, announced in this earnings call of how they're going to hit break even by 2026. It sounds like a bunch of nice words. I'm not seeing the conviction behind it, right? I would have expected to see something happen this quarter. So, I'm going to be looking very closely for the next quarter because something has to change. But he already gave guidance on next quarter is going to be worse than this quarter. So Q1 of 2026, I guess we'll start to see some progress. But I mean, until then, I'm holding, not buying. I don't own any of the stock. But they basically laid out 3 points here. They're going to acquire more homes. They're going to improve on how fast they sell these homes, and they're going to build operating leverage. Three things, they sound good. One, buying more homes. We just haven't seen it happen yet. The company doesn't produce cash flow, so that means they either need to issue equity or debt. So they're either going to dilute us or add debt to the company to buy these homes. So I really don't see this being feasible. Two, they're going to improve, no house sitting on the market for 120 days. Guys, who's buying a house right now? I mean, I don't know. Industry headwind more than a tailwind, in my opinion. And then with this building the operating leverage, I mean, if he really was, his compensation should have been tied to some performance metric, some EBITDA margin, some stock share price. I mean, just coughing up $15 million to have the guy come over here is, before anything pans out, I need to see a lot more performance before I'm buying. So I thought this was really interesting. And I mean, if you want to buy this stock, this is what you need to be paying attention to. It's really cool. It's a little dashboard they wrote down. I think it's called like accountability.opendoor.com, something like that. You can find it. It's in the earnings report. And it's interesting because they're showing how much they project on the left homes they're going to buy. I mean, they're saying by January 2027, they'll cumulatively have purchased 36,000 homes. It's a lot. That's a lot. It's a big increase from where they're at now. I don't even think they're at 1,000 on the year. So I mean, exponential impact. And then on the right here, he has his little graph updating on, their weekly tracking being 69% up. They've already bought 240 houses in 1 month. They only bought 1,000 last year. They're like on track for doubling right now. My thing again is that they didn't make money when the real estate market was pumping and interest rates were low. So now with a higher interest rate environment and lower, personal discretionary expenditures coming from consumers, combined with them never turning a profit, I just don't see how buying more homes is going to help. But, I'll be keeping my eye on these metrics. So a couple things I wanted to point out here just to show you their guidance they gave investors looking forward. They're expected to increase acquisitions by 35%. However you want to take that. I mean, I don't see the financial model or business in place to where they can profit off of this. It's like they're trying to get to size quickly and hope that once they have size, they'll be able to, negotiate prices and kind of, I don't see it. Um, Revenue expected to increase but decrease next quarter by 35% due to low inventory levels. I said this in my last video when I covered Opendoor. I mean, they're buying and selling real estate. I went to try to sell my house to them and they referred me to a private group, so I don't understand. And then even they're not profitable. They can't keep buying companies. So they're either going to have to dilute shareholders or take on debt to buy these homes in a model that's not even proven to work. Okay. The contribution margin, they believed bottomed out in October and margins will improve for the remainder of the year. But Q4 2025 contribution margin will be below Q3. So even worse than Q3. Then I cannot think of another company that structured an equity offering like this. Basically, they're offering you if you buy before November 18th, you get free warrants, and it's like KLZ. It's three tranches. And all in, if they hit their price targets, you get those warrants are exercised and you can get, an additional, I think it's like works out to be like 10% over the long run of, if the stock price hits $7, $9, $12. But, it seems scammy to me. It seems like a money grab. And I say that because I've never seen an equity offering like this. And I even work in private equity. So that's what's really weird. It's really screwy setup. And two, it's kind of like you're incentivizing people to buy the stock today. There's no good information or outlook, but you're giving this tremendous upside, which will come at a 10% dilution. I mean, if the stock goes up to $12, it doesn't matter. You probably made like 400% already, but, it seems a very Herbalife, if you know what I mean. I'm not touching the stock. There's a bunch of nice words. There's, supposedly some proprietary tech and AI and blockchain and all these buzzwords. I got to see results. I got to see houses being purchased. I got to see homes being sold under 120 days. I need to see revenues increasing. I need to see the break even. I mean, he's guiding downward for Q4, and he already missed these earnings, being 30% below what was expected. So God knows what we're about to see in Q4, and who knows what Q1 will hold. So, and I don't even see how they could benefit from interest rates dropping because they weren't profitable back when interest rates were low. So, for me, it's a sell at this point.